joined us today. As Megan mentioned, my name is Gloria Vidovich, and I'm the Plan Giving and Donor Relations Officer here at the Bruce Trail Conservancy. And it is my pleasure to kick off the first webinar of the season following our summer hiatus. Today is the first of a three-part Plan Giving series that we'll be rolling out this year, led by our knowledgeable presenters, Vlad and Candice, and designed to give our members and donors access to valuable resources when going through your estate and financial planning. So I have the pleasure of introducing our presenters today. I'll start with Candice J. Candice has over 15 years of experience in the financial industry and is a vice president at CC&L Private Capital. Her practice guides and works with charitable foundations and high net worth clients to achieve their unique financial goals and strategies. Strategic philanthropy is also an important part of Candice's client conversations, and she is passionate about helping clients identify values and areas where philanthropy can play a role. She has extensive experience helping environmental, healthcare, and arts charities, and guides her family's legacy giving to all causes near and dear to them. Candice also plays leading roles in the charitable community and is on the executive board of the U of T Alumni Association and UHN Foundation. She's also a member of the Canadian Association of Gift Planners and leads engagement and mentorship for professional advisors across Canada. In her spare time, Candice enjoys being in nature with her family and golden retriever. Next, we have Vlad Solokhine. Vlad is a certified financial planner with over 15 years of experience in the financial services industry. He's a team member at the Lazar-Wealth Succession Strategies, a financial planning boutique in Markham. Before starting his own financial planning practice in 2012, he had the privilege to work in a major Canadian bank, an insurance company, and a mutual funds company in advisory and senior management roles. In his practice, Vlad specializes in philanthropic planning, helping people with disabilities, and people in career transition. He's the chairman of the board of High Note Savante, the registered charity that inspires people touched by mental illness through artistic expression. Vlad is also a member of the Professional Advisory Committee at the Canadian Association of Gift Planners. He's well known among Ontario environmental charities as a plan giving expert and a webinar host. In his spare time, he enjoys hiking and exploring the Bruce Trail. Before I open the floor to them, I just wanted to take a moment to share that Candice and Jay have made a very generous commitment to work with our charity peers across various sectors in a volunteer capacity like today to help raise awareness about the various giving strategies available to Canadians when planning their estates. We're so fortunate to have their time and talent today, and I thank you both. Over to you.
Thank you so much, Gloria, and hello to everyone, all the wonderful supporters of the Bruce Trail Conservancy. We are so excited to be here today, and we will start off with some statistics on the philanthropic backdrop in Canada, and we'll talk about some of the challenges we see donors go through. We'll take you through some of the main technical instruments for plan giving, and we will tie it all together while leaving a legacy at the end. And Gloria and the BTC had a great session earlier this year on leaving a legacy and creating legacy letters and your personal values conversation behind it. So this is an extension of it. It's taking it one step further today on acting on your vision, your values, and your goals, and bringing it to reality by showing you how to technically create these gifting strategies together. So as Megan mentioned, a reminder just to keep your Q&A questions coming throughout the session, and we'll get to as many of the questions as possible within the hour. And on the next slide, I wanted to start off by sharing with you a staggering statistic on philanthropic giving in Canada. 85% of Canadians donate to charities, but only 20% of them claim their donation tax credits on their personal income tax return. And on this chart, we see the trends in giving from the mid-80s to 2014, which is the most recent study done by Imagine Canada. The orange line represents the donor rate, and you can see it's declining. And the dotted black line is the average donation, which is increasing. And from the peak in the 90s, the percentage of tax filers claiming the donations has dropped by a third, and the average amount claimed has nearly doubled. This means that Canadian charities are relying on a smaller number of people for donations, but beyond that, Canadians are not taking advantage of their donation tax credits. And remember, the first statistic I mentioned is that 85% of Canadians donate to charities, but only 20% of them claim their tax credits. So financial advisors really need to step up and work more with their donor clients to find these efficient philanthropic strategies to maximize their donations and don't let the tax credits go to waste. We're also seeing the generosity of our younger generation, and it isn't reflected in the charity numbers because they don't only give to charities, but they give to crowdfunding, and crowdfunding does not count as a charitable donation. But that doesn't matter to them. Our younger generation doesn't prioritize the use of tax receipts, but rather they want to help their community and they want to do what's good. So hopefully they continue to do what's good, but also take advantage of the tax savings in their actions of giving over time. On the next slide, I show a dollar pie chart. And here is how the government distributes your taxes. So when I ask clients, is this how you would like to allocate your charitable giving? The answer is no 99% of the time. So take a close look at the segments and see if the charity sectors that are near and dear to your heart are even within the pie. Does it have a tiny allocation or is it even on there? This should definitely be a wake-up call that if you're a charity and you're not strategic about what you want to give to and your charity's not there, you need to actually do something about it. You have to be purposeful with your estate planning and your charitable intentions. And your estate taxes is what we call involuntary philanthropy. This becomes the default distribution of your taxes in a estate if you don't actually become purposeful and it goes according to the government allocations. On the next slide, we're looking at the same time frame as the dollar pie chart, and we're looking at the latest study on how private family foundations are giving. And there's still a lot of attention that's needed in some of the funding areas, and I've highlighted the environmental sector in green. So this is a battle for over 50 years already and trying to get more funding, and we're still only at 6%. Charities really need the help beyond what the government can contribute, and that is through private family giving. I'll pass it over to Vlad now to talk about more of the donor challenges that we see, and over to you.
Thank you, Candice. Before we move any further in our presentation, I would like to just stop for a second and think, why are we here today on this particular webinar? Yes, we want to know how to avoid extra fees and taxes, learn some financial techniques, but why really? Obviously, I cannot answer this question for you, but when it comes to me, it's all about generosity. Maybe it's a bit naive to think this way, but I consider generosity as some sort of superpower that I could use towards those who are important to me. My wife, my children, my charity that I believe in. And whether we want it or not, when we leave this world, we literally create an explosion of generosity. Everything that we were building through our entire life will be going to someone, whether it's our family member, our charity, or some government agency. My point is, I want my legacy to be meaningful. It's not the question of how much taxes I save, but rather how will I be remembered? And that is why trying to help you achieve your philanthropic goal, we're going to start with the challenges. We'll try to understand better what could stop you from making sizable legacy impact, even if you have financial resources to do so. Here you could see 5 major concerns that may stay in the way between you and your philanthropic vision. Number 1, well, legacy giving could feel confusing. It is simply too complex. And to make things even worse, the most people who try to explain it start with technical terms such as capital gain, taxation, cash value of life insurance policy, appreciated securities, donation of securities in kind, and so on and so forth. Of course, if you're not an accountant or some other financial professional, those terms do not really sound comforting and self-explanatory. And if I'm a donor and I must understand all this just to make a donation, really forget it. I love your charity. Here is my check as a one-time gift, and that's it. By the way, I just mentioned donation of securities in kind, and I understand that we'd like to avoid technical terms as much as possible, but in this case, both Candice and I are going to use this term a few times throughout this presentation. So to avoid any confusion, I'd like to explain that donation of securities in kind simply means donating of securities directly without selling them. In other words, you might sell your stocks or mutual funds and donate the money, or you could donate those stocks or mutual funds directly without selling them right to the charity. And that is exactly what's called in-kind donation. All right, so now let's say that you studied all these definitions, that you are committed to make a difference and have some financial resources. And yet, quite often, we all could get a consideration or obstacle number 2. We might not want to give it all to one charity only. Many of us support 2 or 3 charities that we care about and we have a relationship with. And if you have just one portfolio of appreciated securities, or say a single life insurance policy, how to split it between 2 or 3 entities? And that's not all. The third challenge is timing. As you know, legacy giving often provides substantial tax benefits. Candice and I will go over some of them later in this presentation. That is why the opportune moment to make a noticeable donation for some people, and a good example would be business owners, is often determined by their accountants. And it might happen in unpredictable moment, and the decision must be made in a short time frame. For example, the owner of 3 Tim Hortons restaurants sells one of them, and as a result, the taxable income for their corporation is much higher than usual. It is, say, 3 weeks before their fiscal year end, and their accountant says, by the way, if you donate $250,000 before the end of this month, it will help with your tax bill. And if you use your investment portfolio for that, it will be even better. Wow. All of a sudden, the Tim Hortons owner must decide on the spot which charity receives the money, and then make sure that they're able to accept the gift in the form of appreciated securities. He generally supports his local environmental charity, animal shelter, and his church, but he has no time to contact them now. So he simply asks his accountant to take care of that. And the accountant does it. He simply picks a big charity name from Toronto subway poster. Why? Just because their name is on the poster and the accountant has another 55 tax returns to complete. That is how timing could definitely be an obstacle standing in the way of your legacy vision. Challenge number 4 is somewhat similar to challenge number 1. Legacy giving strategies could be complex and unfamiliar not only for you, but also for your financial advisor, or for your accountant, or for your lawyer. Imagine when you finally deal with your confusion, decide whom exactly you want to donate and when, you call your financial professional and ask if it's going to be a legitimate strategy. And if it's the first time when they hear about this particular strategy, they may have natural hesitation in recommending it. And that hesitation could be another reason why a sizable life insurance policy that you otherwise might not even need is not going to help you implement your legacy vision. And finally, dilemma number 5. How can I leave sizable amount of money to my charity if I also have 2 children and 6 grandchildren to take care of? I'm not going to spend much time on this right now, and not because it's not important. In fact, it might be the biggest and most important consideration. But later in this presentation, Candice and I will address challenges number 2, 3, 4, and 5 all together in just 3 minutes. And I promise you, it will not be disappointing. Before we do that, let's spend some time on resolving the first challenge, confusion. Let's quickly but efficiently familiarize ourselves with the major legacy giving instruments. Let's move on to the next slide. And I pass it over to Candice.
Thank you, Vlad. And since all of you are here today, this shows that you're supporters of the Bruce Trail Conservancy, and the BTC is within one of your values in supporting the environment. And let's also assume you've gone through the exercise with your financial professional, that you have excess capital on top of your core spending needs to allocate towards charity. So what do you do next? If we move on to the next slide, you can see that we're going to talk about 5 individual techniques and strategies placed under planned giving that you can explore. So the first one, donations in kind. Second one, donating life insurance. Number 3, assigning a charity as one of your RRSP or RRIF beneficiaries and other registered account strategies. Number 4, leaving a gift in your will, also known as a bequest. And number 5, setting up a DonorAdvice Fund, also known as your personal charity structure. And the beauty of these individual plan giving instruments is that you can combine them in a strategic way to make your legacy and plan giving have an even larger impact than doing them individually. Let's explore the first option of making direct gifts of donating securities in kind on this slide. So the Canadian government has created one of the most favorable tax regimes to encourage charitable giving in the world. And in 2006, the Canadian government announced some donation guideline changes, which further incentivize Canadian taxpayers to donate by eliminating capital gains on donations of appreciated securities that are publicly traded in your non-registered or corporate accounts. So for example, if you had bought some Apple stock in your taxable account from day one, you'd be very happy with the gains, but also feel a little trapped because you have to pay tax on all those gains. But this means that donating appreciated securities of stocks, bonds, mutual funds directly to the charity without selling it first, also known as donating in kind, will create a double benefit in that you'll receive a tax credit based on your donation, and you do not need to pay capital gains tax. If you donate from a corporate account, you'll have a third benefit, which is that your capital gains donated will release the same amount that you can withdraw tax-free in your capital dividend account. So let's look at this example on the screen. We have $30,000 of appreciated stock donation. Let's pretend that's that Apple stock with a $10,000 original cost. So you're really only donating $10,000 of your book cost. And so you decide that you want to gift this to your favorite charity. You'll get the same tax credit as a cash donation that maybe you were used to doing. But this time you're going to explore this type of technique, but you get a secondary benefit of not needing to pay capital gains tax on that $20,000 of this Apple stock. So this makes your actual cost of giving of $30,000 only around $12,640 versus if you give straight cash of $30,000, so not even $10,000, $30,000, your cost of giving would be $18,000. So if you had the same example donation from your corporate account, you would have the same benefits, as I mentioned, under a different tax rate, of course, but the capital gains circle you see in the middle of $5,353, that will actually be a tax-free withdrawal number from your capital dividend account. So this is an extremely effective way to donate to charities and to have a tax benefit with a good strategy for new and seasoned donors. So simple, yet effective. And I'll pass it back to Vlad now to talk about gifts of life insurance on the next slide.
Great. Thank you, Candice. The beauty of life insurance policy is that it is very familiar to most of us and yet a very powerful instrument that many people can use to enhance the impact of their legacy. Let's say we have a 60-year-old woman who regularly donates $200 a month to a charity and every year gets an annual charitable receipt for the combined amount of $2,400. Assuming normal longevity, this woman will eventually donate anywhere between $60,000 and $70,000 over her lifetime. However, if that woman buys a life insurance policy, the same $200 a month at the age of 60 could buy her about $104,000 life insurance coverage that she could donate to any registered charity. As you can see, she doesn't spend a penny more, doesn't pay any extra setup fees, and yet sizably increases her charitable gift. She could still elect to get the same annual donation receipt for $2,400, or she could elect to get a single $104,000 charitable tax receipt for her estate that might help the estate offset other tax liabilities, for example, on the family cottage. And all this is done with the same $200 a month. Another benefit of donating life insurance policy, it could be done in complete privacy. Somebody's will, and some people don't realize that, it's actually very important. Somebody's will is a public document. No matter how private you think it is, every person related to the estate or not can examine and contest it. A life insurance policy does not form the part of the estate. It does not have to be disclosed in the will or anywhere else. This type of donation can be legally done in complete privacy, and nobody will know anything about it ever. Well, since we're talking about the privacy and donating to charities, I would like to say that it's a good practice to keep your charity informed about your philanthropic intentions. Board members and officers of all charities that I worked with kept telling me that they would love to be involved with their donors. Of course, they're very grateful to receive a legacy gift when somebody passes away. But if they don't have a chance to establish relationship with you, to have you involved in their activities, or at the very least, just keep you informed about the great things that they're accomplishing with your support, then there is something missing here. Relationship with the charity is really a two-way street, and they're happy to help you, their donor, as much as they can. And I know that they treat their donors' confidentiality very seriously. I'm sure that Gloria from Bruce Trail Conservancy could relate to that, right?
Yes, absolutely. We are committed to pure confidentiality every conversation, and we are honored to work closely with every donor to ensure that the intent of their gift is fulfilled, and it gives us an opportunity to talk about, how they might like to be recognized as well, and if they'd like to remain anonymous, then we will honor that.
Yeah, so I think well, relationship with the charity is definitely part of legacy giving experience. All right, enough with life insurance. Let's move on to the next slide and talk about your registered accounts. I'm sure that many of you know about the RRSP or RRIF spousal rollover. When the first spouse dies, their RRIF or RRSP balances roll over tax-free to survived spouse. And that's why you should always have your spouse as a primary RRIF beneficiary. But what happens when the last spouse or a single person dies? Could the money be rolled over tax-free to their children or grandchildren? Unfortunately, the answer is no. With very rare exception, actually, there is only one exception if there is a disabled child and they financially depend on you. It is not possible to create a rollover to children or grandchildren. In this case, all remaining balances of the RRIF or RRSP are considered to be a taxable income in a single year of death. And it's not unusual for those accounts to have a few $100,000 balances. So when it comes in a single year income, it triggers 53% marginal tax rate. In other words, more than half of the money could go to the government. That is why the main idea is that you do not try to pass your RRSP or RRIF money to your heirs. Instead, it makes perfect sense to start thinking about your charity. If you considered leaving some money from your estate to a charity, the money from RRSP or RRIF would be the most natural and most cost-effective way of doing so. So we have here 3 bullet points, 3 options. Let's examine the bullet point number 1. Most simple, but yet effective, making charity a contingent beneficiary. Both you and your spouse keep yourselves as primary RRIF beneficiaries for each other all the time. However, you add a charity as a secondary or contingent beneficiary. Contingent beneficiary receives the money only if the primary beneficiary is no longer here. That is why, by assigning charity on both RRIFs as a contingent beneficiary, you and your spouse make sure that A, if either one of you passes away, the surviving spouse receives the balance tax-free with spousal rollover. And B, when the last spouse dies, it's the charity that receives the remaining RRIF balance. Unlike any other beneficiary, the charity can issue a tax receipt that will offset the taxes otherwise payable on the RRIF balance. And I'd like to make a little side note here. For some reasons, still unknown to me, some financial institutions refuse to give you an option to designate a contingent beneficiary. You come to them, you say, I'd like to have contingent beneficiary on my RRIF. They say, oh, it's not possible. Again, I don't know why they do that. Legally, there are no restrictions on that. And if you face this situation, do not think that you are dealing with legal restriction. Your plan and that your plan cannot be implemented. Just simply shop around. There are many financial institutions that could hold your RRSP or RRIF and will allow you to name as many beneficiaries as you wish. If you're not sure, send me an email. I'll be happy to direct you. This is overall what we just discussed was a great option for those who want to leave entire RRIF balance to their charity. But what if you want to achieve some sort of balance? What if you want to make sure that your children and grandchildren also receive some money from the RRIF? Then we move to the option number 2. You simply buy a life insurance policy, and you buy it for a fraction of the money that your estate would otherwise pay in RRIF taxes. You make sure that your children and grandchildren are the beneficiaries on that life insurance policy, and at the same time, you designate a registered charity as a contingent beneficiary on your RRIF. So when the last spouse dies, children receive the life insurance payout tax-free. The charity receives the remaining RRIF balance and issues a corresponding tax receipt so that estate will not pay any RRIF taxes. Of course, this option requires understanding of technical aspects of legacy giving and some financial planning skills to select correct life insurance type and amount. So make sure that you seek professional advice when implementing it. And finally, option number 3. Let's say that your children and grandchildren inherit the house, the cottage, some other assets, so you want the charity to get the whole RRIF balance. And if you choose the option number 1 and simply assign the charity as a contingent beneficiary, it's good enough. But you still could increase that gift without adding any extra money, simply by using the power of life insurance. Do you remember my example when the 60-year-old lady could donate anywhere between 60 to 70,000 over her lifetime, but instead she purchased 104,000 life insurance policy with the same money? So this idea, combined with RRIF donation, could be brought to the next level of efficiency. You simply buy a life insurance policy and assign it to your favorite charity, and you pay the premiums on this policy using your RRIF withdrawals. Under normal circumstances, RRIF withdrawals are taxable. We all know that. However, the registered charity will issue corresponding tax receipts that will offset the taxes. In many cases, it will be even more than offset. The tax break could be higher than the requirement tax payment. So you might even receive additional tax break. But some people might say, wait a minute, how about that withholding tax that bank charges me at the spot even before I get that RRIF withdrawal to my account? Well, there is a way to avoid it. There is a government form T1213. You fill it in, you specify that the extra withdrawal is to be used for the charitable purposes, and CRA will grant the permission to your financial institution not to take any withholding tax. It might sound complicated, but believe me, the tax efficiency is worth it. And I went through all these examples to illustrate just one point, that you have a choice. Either allow involuntary philanthropy by paying taxes, or enhance your generosity without any extra cost. You might be surprised, but CRA will be happy to support you. They want us to take taxation in our own hands. Whether or not take advantage of this opportunity, well, it's up to us. And now I would like to pass it over to Candice. Let's move on to the next slide.
Thank you, Vlad. So you may have started to notice a national campaign in Canada called Willpower, and this is led by the Canadian Association of Gift Planners Foundation. So over 50% of Canadians do not have a will. And there's going to be a lot of conversation to encourage Canadians to create, to update, and to leave a charitable gift in their will. Gloria also touched on Willpower in her legacy webinar, and the BTC is a proud supporter of this campaign. And given that Vlad and I are both founding partners of Willpower and professional advisors for the campaign, we wanted to touch on it a little bit more. We know from studies that only 5% of Canadians leave a gift in their will. And with the Willpower campaign, the long-term goal is to have 8.5% of Canadians leave a gift in their will by 2030. And I know this sounds like a long time and a really small 3.5% increase, but that small increase will generate $40 billion to charities. So remember, you don't need to only choose family or charity. You can choose both. And even better, use these strategic charitable giving techniques to help your estate plan and reduce down the tax burden for your loved ones. So we encourage you to visit www.willpower.ca for more information. There is a direct link to the BTC Willpower page on the bottom of the screen here. And you can contact Gloria as well for more information. It's a very easy website to use, and there's a lot of free resources for you on there. And we want to make sure that we just start the conversation with you, hopefully with Gloria, with Vlad, with other professional advisors, and we work collaboratively with each other, from other Willpower advisors to the charities, to make sure that your estate is planned out purposefully. So on the next slide, I want to talk about the last plan giving instrument, creating a donor advice fund, also known as a DAF. And it can really combine everything you learned today. If you want to explore leaving a legacy or come up with a charitable strategy with multi-year gifts, or want to create a family legacy that lasts for many generations, this should be a part of your strategic philanthropic structure. What you would do is set up your donor advice fund under a public foundation or a community foundation and make a strategic gift into your donor advice fund and work on your charitable granting intentions after. Let's go through this donor advice fund journey on the illustration here. You and your professional advisor, it can be your lawyer, your accountant, or your financial professional, have been talking more about philanthropic giving recently, and you've determined that you have excess capital to allocate towards charity and some large gains over the many years of good investing to dispose of strategically. This leads to an exploration of setting up a personal or family charity, and there are many DAF administrators out there to choose from, but that is for deeper conversations because they are very different and you want to choose one that is right for you. Today, we want to focus more on what the DAF journey looks like and how it can help you solve your existing tax burdens. So first, you need to fund your family DAF through strategic donations using some of the techniques we just talked about. We can use multiple instruments that we just covered, or it can be just a simple one like donating appreciated securities into your own DAF. And once you've funded your DAF, on the other side, you'll need to begin exploring how you'll grant out the money according to your family values, your missions, and your overall legacy vision. These conversations often take time and years to really come into a final decision and a lot of effort to put in place. But in the meantime, you can at least take advantage of the tax benefits of having your DAF. So once you have the structure put in place, you can then move on to help focus on your personal or family philanthropy, and you then integrate the values and missions that we and Gloria talked about in her past BTC webinar. You can even support your friends and family's walkathons and bikeathons through your DAF, and no longer need to organize your tax receipts of the 10 charities you donate to because it's organized and centralized through your DAF administrator. And since you are required by the CRA to grant out a minimum of 3.5% per year from your DAF, you do have yearly opportunities that follows yours, your grandkids, or your kids' charitable passions. And for example, if hiking and exploring the Bruce Trail is a passion of yours, and your generous help with the conservation effort of the BCC will allow for future generations to continue gaining access to the Bruce Trail. And always remember, when you're ready and comfortable, to let the charities know that you'll be naming them as a beneficiary or you'll be granting money to them, please give them a heads up, as Vlad talked about before. As Gloria also talked about, they won't bother you if you ask them not to, but they do want to give their appreciation to you. I'll pass it back to Vlad at this point. On to the next slide.
Thank you, Candice. We talked a lot today about different legacy giving techniques, how they work, how they enhance your gifting power, and what tax advantages you could realize by using them. Technically, it all was focused on addressing the first concern that we talked about, which is confusion. Hopefully, by now, you have a better idea what instruments are available at your disposal, but other obstacles still remain in place. For example, how do I split my major gift between different charities? And what if I have to make a gift now, but I'm still not sure who should receive it and when? And what if my financial professional doesn't know much about the gifting strategies that I have in mind? And finally, how about my family? I don't want them to feel abandoned or not appreciated enough. To deal with those concerns, I would like to show you a complete philanthropic solution. Let's move on to the next slide. The core of the complete philanthropic solution is the DonorAdvice Fund, or DAF. As Candice explained to you before, having a DAF is like having your own charity in your pocket, which is ready to help you anytime you need it. You could combine all legacy enhancers that we discussed: donation of securities without selling them, life insurance, assigning RRIF beneficiaries, creating your own will bequests, and then direct them all into your own family DAF. Let's say you open a DAF and call it the Smith Family Environmental Fund, because Smith is your family name and you love supporting the environment. You set up a charitable life insurance policy and assign it to the Smith Family Environmental Fund. And it will be the Smith Family Environmental Fund that will generate the tax receipt for you. Say your accountant pressures you to donate certain amount of money now because it's urgent and it's financial year end and all that. And it is all of a sudden no problem. You donate it to the Smith Family Environmental Fund. Similarly, you designate your fund as a contingent beneficiary of your RRIF or in your will. Every once in a while, you could adjust the list of charities that the Smith Family Environmental Fund distributes money to. But your fund, your Smith Family Environmental Fund itself, doesn't go anywhere. And finally, it becomes a family adventure. You gather everybody, your spouse, your children, grandchildren, whoever you want to get involved, and discuss with them, what charities are we going to support with this fund? In which amounts? At what time? Who is going to run the Smith Family Environmental Fund when I'm no longer here? All this makes it truly a family adventure. And those of us who have grown-up children who live somewhere in British Columbia, like my son, or in the New York City on their own, we know that having a good reason for all of us to get together and do something meaningful is rather a blessing. And that's exactly what Candice and I call a complete philanthropic solution. You use all available legacy techniques. You put your DAF in the center of it. And from the DAF, you distribute the money to the charities that matter to you. Financial providers such as Canada Gives, Mackenzie Investments, different community foundations, and many others will be happy to open a DAF for you. The fee to open it and maintaining it year over year is very reasonable. And it eliminates most of the problems that stand in the way of your personal philanthropic journey. Of course, complete philanthropic solution is not a silver bullet, but probably it is as close to it as it gets. Well, I think it was enough, if not too much information for everybody today. I'm not going to provide any more. Let's just move on to the next slide and summarize our presentation. First, switch to voluntary philanthropy. Make that mental switch. It simply makes sense. If you are obligated to pay dozens of thousands of dollars in taxes, why not to direct this money to the cause you believe in, especially if CRA provides you with a wide range of instruments to do so. Second, understand the challenges that you're going through. There are ways to overcome all of them, and I hope that after this presentation, you might have a better idea how. There is a wide range of technical instruments that you could use to enhance your donation and get additional tax benefit. You don't have to be an expert in all of them, but it's good to know in a nutshell what the instruments are and how to use them. If you combine all available instruments with your DonorAdvice Fund, you create a complete philanthropic solution. It's like having your own charity, which is ready to help you and the causes you care about in the most convenient way. And finally, you're not alone. All technical information that you heard today might feel overwhelming. We're here to help. On the next slide, you could see our contact information. If you're interested in plan giving strategies, give us a call or send us an email. We'll be happy to answer your question and in many cases, help you directly. And by the way, if you had any questions during this presentation, now would be a great time to ask. Let's move on to the next slide. Actually, you know what? I think it's a bit premature. Let's get back.
Thank you, Vlad. Thank you, Candice. That was great. So many different ways that giving can be structured. And it's quite interesting to see how many options are available out there for people, depending on your own unique scenario or circumstances. And as a charity, certainly it's valuable for us to gain a little bit of insight into the types of conversations that are happening from on your end. I'm curious, as advisors, how often would you say that you're opening up the conversations around philanthropic goals versus a client coming in with everything clearly identified? How does that look?
Yeah, I'll start off answering that question. Being a member and quite involved in the CAGP, we do see a lot of advisors come through from all different institutions. And I would say that there's actually not that many that specialize in these philanthropic strategies. So that is something where you definitely want to work with people who've done at least some form of it. I think a lot of people sort of dive into a little bit, but there's a lot more to explore. So I don't see it that often. And I think with Willpower happening nationally, it's provided a great resource to people and to donors to pick people on that list who are lawyers, accountants, other types of advisors who really have a focus of philanthropy in their practice. So that's one thing that we definitely observe out there. And, one thing is, if your advisor doesn't seem to be well-versed, there's other people out there that will do the free consultations and talk to many people about it. Don't just sort of leave it as is, because we all want to help. This is all within actually our own volunteer time as well.
Yes, and I completely agree with Candice. While working with my clients, like most of the time, if not all the time, it's me who starts philanthropic conversation. Maybe because those ways of legacy giving are not really well known. Maybe because people are intimidated. Remember that confusion part as an obstacle. They are intimidated with the complexity of it and they don't even want to start. I think what we all could do is to spread the word. If we could enlighten other people, if we could let them know that, yes, there are ways of supporting charity in a way that we couldn't even think before, let's start doing it all together.
Thank you. So we received, so we've opened it up now to questions, and we'll take a few questions now. I've got one here about RRSP and RRIF beneficiaries. Can a charity be named as a primary or sole beneficiary of an RRSP or RRIF if there is no spouse?
Yes, definitely. I only was mentioning contingent beneficiary to point out the importance of spousal rollover. Like, it should always be in place, but if there is no spouse, by all means, you could just name charity as a primary beneficiary and it solves the problem.
I just want to emphasize too, don't put estate there as your beneficiary, because your registered accounts are actually outside of your state, outside of your will, and your beneficiaries are outside of there. Once you put it back into the estate, then it becomes part of that big pile already. It just will become complicated. So if you directly name it from your registered accounts, the charity, then it will be very simple and the timing of it will be much faster as well.
Could a legacy gift be made from a private corporation?
Oh, that's a very good question. I think I would paraphrase it. Legacy gift better be made from private corporation, because by doing so, you achieve additional tax efficiency that you could either utilize as your own tax break or simply enhance the donation gift by that amount. So everything that we discussed today, donation of appreciated securities or life insurance, everything else could be done from the corporate assets. And they receive all those tax breaks that we discussed here today, plus one additional exclusive corporate advantage, which is a credit to capital dividend account, which simply means that in addition to getting all the tax breaks, in addition to supporting your charity, you also get the right to receive quite a bit of non-taxable dividend. In other words, take the money from your corporation without paying any taxes on top of all other tax breaks. So it is definitely a complex area. It definitely requires professional advice, but it is absolutely super efficient.
Thank you. And how long does it take to open a donor advised fund?
So the donor advised fund administrators, it's usually very simple, 1-page, 2-page application process. It's open the same day. So it's a very fast process. The part that actually takes a bit more time is when you're donating securities over, and that could take 10 days, a month. And so when people rush to do this before year end, which is very common, just a warning of making sure that they don't wait till 3 days before year end to do this. Because if you're donating, if you're just putting cash in, which I mean, great, but not efficient, that was immediate as well. That's just straight e-transfer there. But if you're donating securities, which is the most sort of ideal way to start funding the donor advised fund, that's going to end up taking a lot longer. So always get started, if not a month before, a bit longer, just because of that side of the process. But otherwise, very simple on the donor advised fund side.
Great. And another one for you, Candice. So who can receive money from the donor advised fund?
So once you've gifted your donations in there, any registered charity, they have to be a proper charity, can be recipients of where you want to grant your money to. So really, it becomes quite flexible. As I mentioned before, like if you get bombarded by friends and family asking for bike-a-thon and walk-a-thon donations, you can even fund that through the donor advised fund. So those are all charitable causes that are easily done there. And it's all efficiently tied in together. So if you are someone that has a lot of different charities, then it just gives you less of a headache. If you even have two, it's easier. The donor advised fund administrators, they'll help you through it. There's very good resources there that will help you through the process.
Vlad, the slide where you talked about the different strategies of life insurance, I find that very interesting. It's very creative. Can you just clarify the risk strategy that also includes life insurance?
Yes, definitely. In that strategy, you use two different instruments. You donate your RRIF to a charity. If you are a single person, as it was asked before, you could put it as a primary beneficiary, or you could put it as a secondary beneficiary. But if, say, the RRIF is your major asset, and you'd like to direct some money from there to other estate beneficiaries, to your children, grandchildren, whoever you'd like to mention there. In that case, if you do it directly, if you do it through the RRIF, then that money will be very heavily taxed before they reach their beneficiaries. The idea is to pay right now a fraction of that money and buy a separate life insurance policy. In that separate life insurance policy, you fully designate it to those estate beneficiaries, children or grandchildren. And RRIF, you fully designate to your charity. As a result, when you pass away, children and grandchildren get their payout from life insurance policy, and charity gets the full untouched payout from the RRIF. And in order for it to be truly untouched, they issue the tax receipt that allow you to offset taxes otherwise payable on the RRIF. I hope that it makes it more clear, but I'd like to stress one more time, it requires some careful calculations, so professional advice there is strongly recommended.
Mm-hmm. Mm-hmm. So final couple of questions. We've had a question about whether or not we accept gifts of real estate at the BTC, and we do. So these can be structured both in your estate plans or in your lifetime. So We encourage you to connect with us directly, and we can facilitate those conversations directly with you for those gifts. And also, can the BTC accept a gift of appreciated securities? So yes, we can, and we do. You can either connect with us directly, again, for any of the forms, or you can visit our website. We've made everything accessible online. It's a fairly seamless process once you connect with your broker, but we always do advise to give it a little bit of time. Sometimes it can take some time, particularly it's more important closer to the end of the year when things are closing out, if you do want to benefit from the tax receipt in that calendar year. So this wraps up our Q&A session, unless anybody else on the call had any last questions. Don't think we do. I'm just going to move to the next slide. So just a couple of final points before we sign off. This presentation will be available on our website for future reference. It should be posted by the end of the week. And the second presentation in our series will be held on November 10th. It'll be an opportunity to welcome back Vlad and Candice, and we'll also welcome our VP of Land Acquisition, Anton Diamond, and we'll be talking about gifts of land, how to facilitate those, and the impact that they have to our mission. As Candice mentioned, the Bruce Trail Conservancy is a partner in the National Willpower Campaign. Please do visit the website. Lots of great resources there as well. In closing, I just wanted to say our community of donors is so incredibly important to the work that we do in helping us to fulfill our mission to preserve a ribbon of wilderness for everyone forever. And we thank you for your support and for joining us today. And thank you, Vlad and Candice, for so generously lending your time and your experience and expertise to the Bruce Trail Conservancy and the charitable sector as a whole. Have a wonderful day, everyone, and safe and joyous Thanksgiving weekend.
Thank you, everyone.
Bye.
Thank you.